This episode will look at the preparation of financial statements. When we get to the end of an accounting period, we will be left with account balances. In all of these account balances represent the summary of all the business transactions that affected the various asset, liability, and equity accounts. In order to report how the company performed financially and what its financial position is after all of those business transactions are recorded, we prepare a series of 4 reports. The first report is the income statement, summarizing profits. Then we report the statement of retained earnings, summarizing how much of the earnings have been retained within the corporation. We then prepare the balance sheet that reflects the financial position of the company, and finally the statement of cash flows. In this segment, we are going to be looking at the first 3 of the 4 financial reports. Income statement. The income statement reports the profitability of the company during the accounting period. Notice the heading of the financial report. The first line is the company name. The second line is which report it is. And the third line is the period of time for which this report is summarizing. This is reporting the profitability for the month ended December 31st of 2019. We would take the balances out of the general ledger for the revenue accounts, totaling $6,100 of revenues earned. We would subtract out the total dollar amount of expenses, each type of expense account balance, total expenses, total revenues, minus total expenses. If revenues exceed expenses, we are left with the net income. Notice these single lines. These single lines indicate a subtotal. Then we have the double underline, which indicates end of statement final total. So the income statement measures the profitability, or one small piece of the financial performance. Now let's look at the statement of retained earnings. The amount of earnings retained within the corporation is a summary of revenues minus expenses, or the net income, profits earned, less any of those profits that have been paid out to owners or shareholders in the form of dividends. This company was a brand new company, so it started the period with no retained earnings. The beginning of December, there was 0 retained earnings. This statement is going to show what changed retained earnings from the beginning of the period to the end of the period. So looking at the heading, the first line, standard, is always the company name. The second line of a financial statement heading is always which statement it is. And the third line is the date. Just like the income statement, the statement of retained earnings is reporting the change in retained earnings over a period of time, just as the income statement reported profits over a period of time. The 2 items that affect the company's retained earnings are profits earned, or net income, less any of those profits that are paid in the form of dividends. We could report all of the revenues and expenses again in the statement of retained earnings, but since we already summarized net income in the income statement, we will just take the amount of net income from the income statement and use that in our preparation of the statement of retained earnings. So the company started with 0 in retained earnings, income of $3,470, increased retained earnings during the period. Then in the general ledger, we will see that the balance in the dividend account reflects $200 of dividends paid. As profits are used to pay dividends, retained earnings goes down. So we will show that as a decrease to retained earnings, resulting in an ending retained earning balance at the end of the period of $3,270. We have now prepared a report detailing the profits for the period. We have prepared a report detailing a little bit more information about the equity of the company. Now let's prepare a report that summarizes the overall impact of business transactions during the period on the financial position of the company. This is accomplished through the preparation of a balance sheet. Look at the heading on the balance sheet. First line, company name. Second line, which report it is. This is the balance sheet. Third line, notice the date of the balance sheet. This is reporting the financial position of the company on one day in time. The income statement and the statement of retained earnings were showing the change or the impact summary of transactions over a period of time, over the entire accounting period. However, the balance sheet is reporting the assets, liabilities, and equity on just the last day of the accounting period. Think of the balance sheet as a snapshot or a screenshot, one day in time, of the assets, liabilities, and equity, or the financial position of the company. So using the ending balances of all of our asset accounts right out of the general ledger, and the ending liability accounts, and ending common stock balances. The amount of retained earnings in the general ledger, as we were recording transactions that affect retained earnings, which are revenues, expenses, and dividends. Recall that in the general ledger, the retained earning accounts are all broken out into the different accounts, revenues, expenses, and equity. We have already summarized the change in retained earnings to get the ending retained earning balance on the statement of retained earnings. So we will use the ending balance from the statement of retained earnings to prepare the equity section of the balance sheet. Total assets of $42,470 equal total liabilities and equity of $42,470, indicating that our accounting equation is in balance. So recall that in order to prepare the financial reports, we must first start with the income statement, because the income statement net income is used to prepare the statement of retained earnings. We then prepare the balance sheet, because the ending retained earnings from the statement of retained earnings is used to prepare the balance sheet. The fourth and final report, the statement of cash flows, would be finished next after the balance sheet. But we are going to learn a lot more before we learn how to prepare the statement of cash flows.